welcome. You're watching Financial Planner, and it's been 25 years since the mutual fund industry in this country has got privatized. A lot has changed, and a lot stands to change. No better than Feroz Aziz to discuss this with. Feroz, 25 years behind us since the MF industry has been privatized. We leave a lot behind and have a lot more promise that lies ahead. But in a nutshell, what has changed in the last 2.5 decades?
See, I think there have been landmark changes when it comes to mutual fund industry. I think if I highlight prominent ones, if I have to highlight three big changes, there used to be one regime where privatization happened in '93, and the clear understanding of the investor was not as much. So advisors used to give some degree of mis-selling because of entry loads. Entry loads were abolished, which was one very, very good thing SEBI did. Otherwise, advisors would exit and re-enter into other funds to get more monetary motivation. I think that was one big change. Second big change to my mind in the recent times SEBI did was to educate people and cull out a budget on a yearly basis from the existing assets. So almost 430 to 440 crores of budget on investor education at the cost of existing investors is being spent in a very minuscule portion, 0.02%. That has created a large traction, and that's why industry over the last 3 years has almost doubled, if not more. And the third big change is client centricity in terms of fee and transparency, which SEBI just did in October 2017. I think these three are the massive transformational changes to deliver the best value creation vehicle which is available to oneself in the next 4, 5, 10 years or 15 years.
While the industry is transformed by leaps and bounds in the last 2 decades, how much more evolution do you think is around the corner? So how does our mutual fund industry compare to the rest of the world?
Yeah, you've highlighted the right point, Samina. I think we are just scratching the surface. If you look at the total number of folios or accounts which are there is about 6 odd crores. And the individual investors estimated to be little upwards of 2 crores. So we have only 2 crores out of 138 crore population estimated, which is participating in mutual funds. Other emerged countries have upwards of 30, 40, 50% of that population invested. So in the next 10 years, my estimate is if SEBI keeps this rule, there will be a good 8-10,000 crores spent on investor education, and that will bring in a lot of Indian money from the lower strata as well to propel the capital markets using the vehicle of mutual fund. So point one I'm saying is there's a lot of energy being spent in investor education. There are campaigns like Mutual Fund Sahi Hai, which has gained immense traction, and that's why you see this kind of folio addition in the last quarter. 23 lakh or little upwards of that kind of new accounts have been opened, even when the market hasn't delivered so well over this last quarter.
And do you think that pace of growth could continue? Because Feroz, at the end of the day, the government, the regulator, wealth management outfits like yourself are doing so much and more in terms of financial inclusion, educating, like you said, campaigns are being run, awareness is trying to be created. Keeping that in mind, and of course the lukewarm returns that has probably played spoilsport to a certain extent, going ahead, do you think this sort of growth, this sort of addition of folios can be still expected over the next 5 to 10 years?
I think definitely, because there's a concerted effort. Now, for example, BTVI has been propagating Save, Invest, Prosper for such long periods of time as a responsible electronic or business channel. So there are several stakeholders who are actually trying to propel this and educate people. And fortunately, the next driver of the mutual funds assets would be SIPs, systematic investment plans, not the large clients only. So SIPs, it doesn't really matter because you are staggering your money. So a person who's looking at an SIP statement doesn't get too disappointed because there are further investments going to be bought at a reasonable price if there's a market correction. So to answer your question, I very strongly believe that the growth rate will continue. If not in percentage, at least in absolute numbers, because as the base becomes larger, percentage growth might look smaller, but in terms of numbers, number of accounts, number of people participating, the growth rate will continue and in fact grow. If you're spending that kind of money in investor education, it is unlikely, unless used inefficiently, will not trigger growth to my mind.
Because while you said that even last quarter there was addition in folios, equity mutual funds saw a degrowth. I think the bigger chunk of growth came in because of ETF, because of Bharat ETF. Is that where the large part of inflows are going into?
See, one is net inflows, by which I mean how much went out, how much came in. The arithmetic difference between that is net inflow. Net inflow gives sometimes a distorted figure, because for every 10 small investor, there could be one large investor who takes back his money and distorts the figure. But if you look at equity folios, there were 4 crore 31 lakh odd. That has grown to 4 crore 55 lakh folios. In fact, the largest addition has come on 23 lakh folios have been added on the equity mutual fund side. ETFs have got 1,16,000 folios, but the base was small, so the percentage increase in the number of accounts on ETFs is 15%, but there is 1 lakh folios added there, 23 lakhs on the conventional equity side. So 23 lakhs is significantly larger than 1 lakh, but in percentage, of course, like you rightly pointed out, ETF has seen the maximum growth of accounts in the last quarter.
As we go along as well, Feroz, where do you think the maximum inflow is going to come into? Is it going to be income funds? Is it going to be equity mutual funds? Is it going to be balance fund, gilt, gold ETF, overseas funds? Where do you think the trend or the sort of flows are going to be directed to over the next few years, if not a shorter period of time?
I think the trend will be in the equity side, because as an investor, I have alternatives on the debt side. I can have PPF in my debt category. I have fixed deposits largely, as Indians have a large exposure there. Debt mutual funds will have lesser inflows for one big reason being there are other alternatives. If I have a girl child, I can use Sukanya Samriddhi Yojana, for example. So on the debt side, there is EPF, PPF, all these government linked or government backed savings plans are there, even a post office saving for that matter. But to participate in equity, either you go directly for a retail investor, or you have a mutual fund vehicle, and I definitely think mutual fund could be boring, and buying a stock could be far more interesting, but the purpose of investing is not entertainment any which way. So I very strongly feel equity will take the next leg of growth, because there are alternatives at least available on the rest of the categories, but equity for a retail investor has to be mutual fund vehicle, because buying stocks might not be everybody's cup of tea.
Also, very lastly, tax breaks, tax incentives, tax efficiency of this product range that you want to tell us about that could encourage our viewers to go out and invest in these mutual funds.
See, equity was taxed at zero, both on the stock side directly which you own, or on the mutual fund side till April this year. That has been brought to 10%, but it is still relatively significantly better than a fixed deposit, which can be at marginal tax rates depending on the person which is there on the slab. So 10% taxation, deferable. So you don't pay the tax till you exit. So if I've entered today and I am going to be holding it for 15 years, I will be able to compound the tax money for the next 15 years. So there's a difference between paying it every year and paying it at the end. So equity gets 10% tax. If you defer the tax by not exiting for 15 years, the tax in effect in percentage terms on IRR comes down to only 5%.
And that is the power of compounding. So that's why this is an investment you need to look at for the long term. The setup in India has changed, but like Feroz said, we're only scratching the surface, and there's a lot more to go till the mutual fund industry in India evolves to compete with its international peers. With that, completely out of time. Thanks, Feroz. Always good talking to you. Have a good day.